an export surplus to that country. If the importers from South Africa deposit their gold in the bank, the result is an increase by the same amount in bank reserves as the bank deposits the gold of the central bank, which increased its gold assets by the same amount. The public's demand for gold remains a factor of decrease of bank reserves, or conversely, the public's increased deposits of gold of the banks, that is, lower demand for gold, raised bank reserve by the same amount. So far, we have seen how the public, by its demand for gold, or nowadays, its demand for cash in the form of central bank notes, will have determined bank reserve by an equivalent factor of decrease. We must now turn to the major instrument by which the central bank itself has determined the reserve of the banking system. Loans to the banks. One method by which the central bank expands or constructs total bank reserves is a simple one. It increases or decreases its outstanding loans of reserves to various banks. In the mid-19th century, the English financial writer Walter Baker Holt decreed that the central bank must always stand ready to bail out banks in trouble, to serve as a lender of last resort in the country. Central banks generally insist that borrowing from them is a privilege, not a right conferred upon commercial banks, and the Federal Reserve even maintain this about members of the Federal Reserve System. In practice, however, central banks try to serve as an ultimate safety net for banks, though they will not lend reserve indiscriminately. Rather, they will enforce patterns of behavior upon borrowing banks. In the United States, there are two forms of Federal Reserve loans to the banks: discounts and advance. Discounts, the major form of Fed loans to banks in the early days of the Federal Reserve System, are temporary purchases by the central bank of IOUs or discount on to banks. These days, however, almost all of the loans are outright advances made on the collateral of U.S. government securities. These loans are incurred by the banks in order to get out of difficulty, usually to supply reserves temporarily that have fallen below the required ratio. The loans are therefore made for short periods of time, a week or two, and banks will generally try to get out of debt to the Fed as soon as possible. For one thing, banks do not like to be in continuing quasi-permanent debt to the Fed, and the Fed would discourage any such tendencies by a commercial bank. Figure 10.6 describes a case where the central bank has loaned $1 million of reserves to the Four Corners Bank for a 2-week period. Thus, the central bank has loaned $1 million to the Four Corners Banks by opening up an increase in the Four Corners checking account of the central banks. The Four Corners reserves have increased by $1 million, offset by a liability of $1 million due in 2 weeks to the central bank. When the debt is due, then the opposite occurs. The Four Corners Bank pays its debt to the central bank by having its account drawn down by $1 million. Its reserves drop by that amount, and the IOU from the Four Corners Bank is cancelled. Total reserves in the banking system, which had increased by $1 million when the loans were made, dropped by $1 million 2 weeks later. Central bank loans to banks are a factor of increase of bank reserves. It might be thought that since the loan is very short-term, loans to banks can play no role in bank inflationary process, but this could be as simplistic as holding that bank loans to customers can really increase the money supply for any length of time if their loans are very short-term. This doctrine forgets that if outstanding bank loans, short-term or no, increase permanently, then they serve to increase reserve over the long run and to spur an inflationary increase in the money supply. It is admittedly a little more difficult to increase the supply of outstanding loans permanently if they are short-term, but it is clearly an insurmountable task. Still, partly because of the factors mentioned above, outstanding loans to banks by the Federal Reserve are now a minor aspect of central bank operation in the United States. Another reason for the relatively minor importance of these factors have been the spectacular growth in the last few decades of the federal funds market. In the federal fund market, banks with temporary excess reserves of the Fed lend them literally overnight to banks in temporary difficulties. By far the greatest part of bank borrowing of reserve is now conducted in the federal funds market rather than at what is known as the discount window of the Federal Reserve. Thus, during the 1920s, banks borrowed reserves from the Federal Reserve were up approximately 4 to 1 over borrowing from the federal fund market. But by the 1960s, the ratio of Federal Reserve to federal funds borrowing was 1 to 8 or 10. As Parker Willis stated that it may be said that in the 1920s federal funds were considered a supplement to discounting, but that in the 1960s discounting had become a supplement to trading in federal funds. To get an idea of the relative importance of loans to banks, on January 6, 1982, the Federal Reserve Bank owned $1.5 billion of IOUs from banks. In contrast, they own almost $128 billion of U.S. government securities. Over the various 12 months, member banks borrowing from the Fed had increased by $335 million, whereas U.S. government securities owned by the Fed increased by almost $9 billion. If the Fed wishes to encourage bank borrowings from itself, it will lower the rediscount rate or discount rate of interest it charges the banks for loans. If it wishes to discourage bank borrowings, it will raise the discount rate. Since lower discount rates stimulate bank borrowing and hence increase outstanding reserves, and higher discount rates do the reserves, the former is widely and properly regarded as a pro-inflationary and the latter an anti-inflationary device. Lower discount rates are lower discount rates are inflationary and higher rates the reverse. On that is true, but the financial press pay entirely too much attention to the highly publicized movements of the Fed discount rates. Indeed, the Fed used change in these rates as a psychological weapon rather than as a measure of much substantive importance. Still, despite its relative unimportance, it should be pointed out that Federal Reserve rediscount rate policies have been basically inflationary since 1919. The older view was that the rediscount rate should be at a penalty rate, that is, that the rate should be so high that banks could clearly borrow only when in dire trouble and strive to repay very quickly. The older tradition was that the rediscount rate should be well above the prime rate to stop customers of the bank. Thus, if the prime rate is 15% and the Fed discount rate is 25%, any bank borrowing from the debt is a penalty rate and is done only in extremis. But if the prime rate is 15% and the Fed discount rate is 10%, then the banks have an incentive to borrow heavily from the Fed at 10% and use the reserve to